Hello and good morning, listeners. Welcome back to Almus Market Mornings, your daily dose of global financial updates. I'm your host, Swaraj Rajagopal, and we have got you covered on everything from currency shifts to pivotal central bank decisions and important speeches. Plus, you'll gain expert analysis on macroeconomic data that's shaping the market narrative right now. Join us for this episode and navigate the markets with confidence. Rate cuts are on their way. If you missed last week's updates, that's a message you can take home, or at least that's what the markets think you should be taking home. After a weaker non-farm payroll, there is a strong rise in bets for a 50 basis cut in September by the Fed. Not just that, Yuan and Yen are gaining big time against the USD. Yuan trading somewhere around 7.12. Last week, this time it was around 7.25, and the Yen at 145 against last week's opening of 153. Good morning, JK. These are large set of moves. Do you think reaction post the NFP are little on the extreme side? What's your take?
Yeah, good morning, Swaraj. So what is shifted in the last few days from the trend that we have seen all along has been that the bad economic news is now read as bad news. If you recall, earlier bad news was treated as good news because that meant rate cuts will happen and that will support the market. Now the hordes of bad news is so much that people have started to worry about how deep the impact on the economy is going to be, on the companies going to be. And also, if you look at the geopolitical news, bad news is definitely bad news because, we are also hearing that Biden is convening a national security team on Monday to discuss the Middle East development. So these are some things that the markets cannot ignore. That's why, the fall in dollar yen and the yuan, which you mentioned, they are, much less looked at than the stock markets, which have fallen, substantially. Nasdaq is clearly into corrective territory, falling more than 10%. More alarming is the Japanese stock market, which has fallen into a bearish territory, having fallen 20% from the peak. And Japanese authorities are already talking, the reverse, watching the market very closely, in the sense that, yen strength and other news in leading to big fall in the stock markets. I think any government, because stock market is a very important segment of the economy, and when there is such falls, I think governments do get concerned. So that is the kind of situation we are in, severe falls. But why the change in the interpretation of news as bad instead of good is because of the market positioning. We have seen markets are going one way all through, be it the dollar yen or the stock market. These were one-sided moves, and we did not see any meaningful correction in any of these segments. And now the triggers are so heavy, and the positioning is also so heavy, particularly in the carry trade segment, that you are seeing these moves very much. Of course, the nearby trigger was the economic data from US. Unemployment data really disappointing. New jobs created 1,14,000 versus 2,06,000 last month, which was, of course, revised down. Unemployment rate going to 4.3%. That's more than 3 years low. And even the earnings, hourly earnings, or means the wage inflation has also been lower. There's more confirmation that the manufacturing is continuing to slow down after the PMI, which came at 46.6 on the sharpest contraction since November 23. Factory orders also fell on Friday. That came at minus 3.3 versus minus 0.5. So all around there is a weakness that is seen in the US economy, and definitely market will be looking nervously at more data that is coming up. Yes, rate cuts have been discounted to a great extent, but then Fed's words have not are more important. We don't have the Fed meeting until another 5.5 weeks from now, but we'll have a chance to hear the Fed members in the coming days. Also, there is the Jackson Hole meeting, which normally throws out some policy perspectives from the Fed. That is something that's coming up on August 22nd and 23rd that can lead to some indications on what lies ahead, whether the market is going overboard on rate cuts or whether it's reasonable. Meantime, markets are talking, of course, increasing one more indicator of the recession, that the SAM rule, where the unemployment rate is more than 0.5% above the average of the last 6 months. And yes, but what can we say about the recession indicator? We have been seeing inversion in yield curve, and we are also seeing the fall in temporary jobs, which is also seen as another indication. All these things have not really, leading economic indicators, for example, they have been in the falling trend for quite some time. But the economy has shown actually more than 1.5 to 2% growth consistently. So a recession is definitely not something that that is realistic, at least for now. Therefore, not to get carried away. For me, the market positioning and heaviness of the negative data, geopolitical developments, and of course some disappointing results from big tech companies. These are behind these market moves. Bonds rate cut expectation of more than 1% as per CME. And geopolitical led safe haven buying has led to 10-year and 3-year, sorry, 2-year trading well below 4% now. Of course, they are not far from big support of 3.5%, because let's not forget that the US debt and fiscal situation are not good enough to are not good enough to support the yields at such low levels without Fed without economy getting into a recession or Fed actually cutting the rates. So stocks have, as I said earlier, liquidating on perception of overvaluation now being played out with all the strong reasons that is coming about. On the currencies, yen obviously has taken the limelight, falling well about 10% from 162 that was seen in July. Japanese central bank on cut hike in rates actually gave the impetus to dollar yen to move down, and then of course the carry trades being triggered, and the unwinding of carry trades also being seen heavily. That is behind this big yen moves. And yuan also, I think, positioning well. Market went on bidding dollar because of various outflows and also the negative news from China. Chinese central bank was very strongly holding at 87.30 levels, and that has led to sharp retreat in the yuan as well. Dollar index, though it has fallen after the jobs data, I think it's not going to break 103 in a hurry. It requires actual rate cuts or more bad news from the economy to trigger that, because the other economies also are struggling somewhat. So we need more news for the dollar index to move out of the range. Also on the rupee, offshore trades are showing above 83.80. Normally we would have seen even RBI actions in the offshore market to bring it down to previous days traded levels, but at least for now that has not happened. It may possible that India is at least catching a bit of cold while other countries are facing the severe infections, and so this can lead to some FI outflows, because what we see normally is that when FIs make big losses in other markets, they tend to take profit in the markets where they are holding good positions, and that can lead to some sort of FI flows from India as well. In which case, RBI may be okay to let the rupee fall, marginally towards 83.80 or 83.85, and the risk aversion, of course, is playing out for the time being, and a lot of good news from India is also being discounted. So again, the positioning might weigh on the currency as well as on the stock market in India as well. But otherwise, I think every day is we look forward to new developments on geopolitics and economics, and I think keep yourself on the toes for the time being. Thank you.
Thank you, JK. And I think if I were to summarize it, I would summarize it as markets being strange. Earlier, bad news was supportive of the rate cut bets, which was usually treated as good news, while now bad news is somewhere being treated as bad news and resulting in a sell-off. Stocks have fallen, yields have fallen, dollar has fallen. Unemployment rate is more than 0.5% higher in the US, which typically is used as a sign of a rate cut and weakness in the underlying economy. Rupee continues to trade weaker despite appreciation in other Asian currencies. That's it from us today. Thanks for listening. Tune in tomorrow for the latest on the financial markets.